Right? So you observe a new forward price, and you just say that you do the opposite. Like if you bought it, now you're selling it at that price. And then you don't have to physically do that, but just hypothetically, if you sold at the current price, what's the profit and loss that you're making? That's what your value is. Now there's one little trick here that we have to keep in mind, because the cash flows from the forward happen at the maturity date. They don't happen immediately. Right? So if you're buying and selling a forward, all these cash flows are occurring at the maturity date, so we basically just need to discount them. So the formula for the value is down here. F0 is the price that you paid or that you agreed on when you entered the forward contract. That's not going to change over time. That's your fixed component. So this here is the price initially agreed on. That stays constant over the same, with the whole lifetime of the contract. That is something that happened in the past. Now your current time is time little t, so that's at some point in the future. So if we do a timeline, you have time 0, time little t, and you have the maturity date. So our valuation date here is time little t. And at this time little t, you might observe a new forward price. That will be the price that investors agree on today to enter a new contract that has the same maturity date. And that price will be f little t, and in parentheses we always have the maturity date. So this here is the current forward price for a contract with the same maturity. Little t. Right, so this is now for a long position, right? So if you agree to buy the contract, you have to pay this price in the future. If you then unwind it, do the opposite thing, is that will be the price for the selling, so the difference is your profit, right? Or loss. This can be a positive or a negative number, right? If the forward price went up, you're making a profit if you have a long position. If the forward price goes down, then you're making a loss, right? But these two cash flows, they occur at the maturity date. So what we have to do is we have to discount that to our valuation date. And that's your profit and loss for the forward, the value of the forward. The value for a short position is then just the opposite of that, right? So if the forward price goes up, there is a profit for the long position, but the profit of the long position must be the loss of the short position. Right, so for the short position, just put a minus in front of it, or reverse the order here. Derivatives like this are kind of a zero-sum game, right? If you add up all the profits and losses of everyone together, you end up with exactly 0. So, as a reminder, you start off with the value of 0, right? Because forward is priced in such a way that there is no cash flow today. If there was a positive or negative cash flow, that would imply that the value is not 0. So it must be fair for both sides, and the buyer and the seller only agree if kind of the value for both of them is 0. That's the only value that you can agree on, basically. That's what I called fair for both sides when I mentioned this over here last week. What I had in mind was saying the value of this thing is 0. And then over time, if the forward price changes from 0 to little t, of course, then the value can change. Okay, so in this point, in the valuation is the big difference to the futures contract. And why is that the case? So the reason for this is the so-called clearing mechanism that's described here. So futures are traded, as I mentioned, on an exchange. But to be eligible to trade on the exchange, you basically need to put up some money up front as a security. Right? So you have to open a bank account with the exchange. Well, actually, it's a subsidiary of the exchange, the so-called clearinghouse. Right? So the exchange itself is a company, and then they have a separate company which is protected from everything else. That's the clearinghouse. The clearinghouse operates for every market participant, basically the bank accounts. So you have to put up some money up front. And then what they do is that at the end of every day, they look at what is your current profit and loss. And that if you make a loss, the money is immediately withdrawn from your bank account. And if you made a profit, it's immediately kind of put on your bank account. So if you can compare like those two settings, if you look at what the forward trading looked like, suppose you have three market participants, A, B, and C. And when they use forwards, they can only trade among each other bilaterally. Right? So that could be a trade here, and that could be a trade here, and that could be a trade between those two. Right? But everyone would have to agree between each other, kind of create contracts and whatnot. Now, on an exchange, when you have the futures, basically the people are not directly trading with each other anymore. Basically, everyone has a relationship with the clearinghouse only. Right? So the clearinghouse sits in the middle. And all the different counterparties, they have relationships with the clearinghouse. But not among each other. So what's the benefit of this? Suppose that C is getting into trouble and they're going bankrupt. Right? So what happens is that B and A might be subject to losses depending on what their position was. Suppose that C owes them money that would, for a forward, be paid at the maturity date, so you're probably never going to see that. So there were some cases around the bankruptcy of Lehman Brothers where there were kind of also exchange cash flows in their German bank. I think it was IKB. So what they did is on the Monday morning, they were kind of sending a cash flow. It was a currency transaction, so they were sending amount in euros. I think it was 300 million euros. And they were waiting for the corresponding US dollar cash flow to come back from Lehman Brothers. So they send out the money, and of course they never received anything back, right? Just because the people didn't watch the news over the weekend. I mean, it was pretty obvious that it was happening, right? On Monday morning, everyone knew about it. The problem was they had like this bilateral risk between the different counterparties. Now, when this happens here, basically it's not a big problem because first of all your contracts are terminated immediately, and you have that money on the bank account. So basically, they take your money from the bank account to pay off the profits, and only when that drops to zero, the contract is immediately terminated. And then the other market participants will be free to create a new contract without really suffering too big losses. If there is ever a loss in this clearing system, it will be distributed among all the participants on the exchange. Right? So it's like a socialism in capitalist word. So the basic idea here is to insure yourself against counterparty risk. Right? So the risk that someone goes bankrupt is almost eliminated, and it's very, very safe. Now, this changes a little bit the picture because now you have to put up money up front. Right? You need to put money into your bank account. The deposit that's required is called the initial margin. The bank account is usually called the margin account. This will depend on what product you're trading. Right, what the volatility of that product is, how far it's moving. So typically it's covering a couple of days profit and loss that you would expect. And then it depends on the settlement frequency. So typically you have daily settlement. That means that at the end of every day, the bank account, the balances on every account are adjusted. If you make a profit, the bank balance goes up. If you make a loss, it goes down. Now there's a minimum threshold, so when your bank account value drops too low, you need to inject more money to keep the contract alive. That's the so-called margin call. There's actually a movie called Margin Call, which has nothing to do with this. It's basically telling the story of Lehman Brothers, the last night. So in the evening they discover that, and then they kind of rally all the troops to the office, and they have board meetings. It's very entertaining. It's my favorite kind of movie about the stock market crash. Much better than the Wall Street movies. But it has nothing really to do with the margin call, right? It's just wanted to look for a fancy title that's somehow related to finance. Like most finance movies are bad because they're just doing like like in Star Trek when they use like technology words that no one understands. It's the same thing. They just throw in the words. It doesn't make sense what they're saying. And this one is kind of okay. I think it's with Zachary Quinto and Kevin Spacey. It's still politically correct to watch Kevin Spacey movies. I don't know, but I like it. Good. So, so if you ever hear the word margin call, it's related to the amount of money that you have to put up front on a clearinghouse. And after the default of Lehman Brothers, basically the European Union is trying to move more and more trades from the OTC markets to clearinghouses to eliminate counterparty risk, right? Just to mitigate the chain effects that kind of one bankrupt goes bankrupt, that this kind of has effects on like ripple down effects on everyone else. Right, so it's a good idea. It limits also kind of the extent of speculation. Now it's not absolutely free to enter a forward contract. Now you have to put in some money, and if you make losses, these are covered